Hey, Dan Passarelli here. Well, I observed a bit of an anomaly today, and I wanted to share with you. I think it's really important. So, one of the things that I watch all the time is the VIX. That's the CBOE Volatility Index. And the VIX is fairly elevated right now. It's 25.65 when I'm shooting this a little bit before the close here today. That's telling, especially coming up here to the Fed announcement on Wednesday. That's pretty telling. But what's even more telling is the VIX term structure. Right now we have a flatter than normal VIX term structure. And I want to talk about how to read VIX term structure so that we can extract some information from it. So take a look here. So these are the VIX futures. Now the VIX options settle actually into cash, but we use the VIX futures as a proxy for their underlying. So we're at about 2560, 2565 right here for the Septembers that are first to expire in a couple days. And then here we're at 2550, so not really much different. And then we go out one more expiration and we're looking at about 2610, so just a wee bit higher. That's when we start to get towards the next earnings season. Here we're looking at about 2650, so just a tiny bit higher. And here we're looking at about 2640, so right around the same. And then as we go back even farther out in time, 2680, a tiny bit higher, 27, tiny bit higher. Jumping into next year, we're looking at about 28. But for the rest of this year, looking at the VIX term structure, usually it's a lot steeper. Usually the further out in time you go, the higher the VIX. And we see that in the futures. The higher the VIX futures, the further out in time you go. And that's a little bit of the case here, but not very much. It's fairly flat. And why might that be? Well, what is the VIX? The Dow Jones Company and Barron's and all that, they call the VIX the fear gauge. And so what this is telling us is that both in the short term and the long term, there's a fair amount of fear. In fact, it's pretty steady from now until the end of the year. Now, that's rather interesting coming up in front of the Fed meeting that is this week, right? Because what happens a lot of times is just the front expiration or the front couple expirations get really high and then they collapse right afterwards. This is predicting not much of a collapse. This is predicting that the market will continue to be volatile. And I think I know why. The Fed funds rate that's traded at the CME Group, they're pricing in about an 86% chance of a 75 basis point hike. Now that's pretty much expected, but and normally for the past few rate hikes, everybody kind of knew the score. Some people might say, oh, it could be 1 point. Some people said, oh, it could be, 50 points. But the majority was like, yeah, it's probably going to be 75 points. Now, that is the general consensus, but we've got Larry Summers coming out and saying it needs to be a 100-point hike. And then we've got other people saying it should only be like a 25% hike. We're starting to get a more disparate set of expectations and beliefs at what it should be. So I think when the Fed announces the interest rate hike this Wednesday, I think it's going to lead to a fair amount of volatility that day and maybe the rest of the week. And I think that up until the November FOMC meeting, we're probably going to have some more volatility going. That seems to be what the VIX is telling us. It's interesting. There's a lot of useful information when you know how to read the VIX term structure. And I hope that helps. This is Dan Passarelli, Trade Smart.